Hello friends, let's understand what is liquidity. What is liquidity? In simple terms, liquidity is availability of liquid assets to company, investor and trader. Let's consider an example to understand what is liquidity. Let's take water and ice. Definitely, water is more liquid than ice. Assets can be fully liquid, that is easily convertible to cash. Assets can be partially liquid, in which it can be converted to cash after following certain restrictions. And assets cannot be liquidable at all, like ice, which cannot be converted in cash. What does liquidity mean for a company? Liquidity is a company's ability to convert assets to cash or acquire cash through a loan or money in the bank and to pay its short term obligations or liabilities. Now let's understand what is liquid ratio. Liquidity ratio measures a company's ability to pay debt obligations and its margin of safety through the calculation of metrics including the current ratio, quick ratio, and operating cash flow ratio. Now let's understand by taking an example of balance sheet of a company. On the left hand side you can see current assets and fixed assets. Current assets are the most liquid of all the assets. In current asset, the most liquid is the cash. Then comes the account receivable. We can see that account receivable are in line with cash as the customers pay you, you immediately have the balance. Inventory can be said to be reasonably liquid as you can sell the inventory and then have the balance. On the other hand, the fixed assets are not very liquid as if you need to generate cash on it, you need to first produce product through it and then sell the product and then you need to collect the receivables. So it's a process which needs to be followed. If a company wants to see if it's liquid or not, the company needs to check its current ratio. Its current assets should be more than the current liabilities. The current ratio should be greater than 1. Only then we can say that the company is liquid company. Now let's understand what is a liquidity for an investor. Let's take an example of Naina's investment and Vikram's investment. Naina has basically invested in property, antique paintings and cash. Vikram's investment consists of bonds, stocks, cash. Here we can say that Vikram's investment is highly liquid if compared to Naina's investment. For example, if they both want to buy some property or equipment, who is in a better position to buy that? We can definitely see that Vikram is in a better position than Naina to buy the product or the equipment, as his assets, his investment can be easily convertible into cash.